In this video, I want to talk a little bit about what a call option is. A call option lets you control stock until the expiry of that particular call option. Now what that means is, rather than buying the stock, you can in fact buy a call option and potentially benefit or profit as that stock rises in price. For example, if you were to buy 100 shares of IBM today, let's say, is trading at $200, you would have to pay roughly $20,000. Now, you could, on the other side, rather than buy IBM shares, you can in fact buy a call option, and a call option may only cost you $5 a share. And so, to roughly buy this or control the same amount of shares as you would for 100 shares of IBM, you could in fact buy one call option contract, because a single call option contract controls 100 shares. So instead of investing $20,000 to control 100 shares of IBM, you could in fact buy one single call option which still controls 100 shares, and you'd only have to invest $500. Now the difference here might be the actual dollar amount profit that you would make should IBM shares rise. So if you actually have the IBM stock and you had 100 shares, if the price of IBM shares rose by $10, because you hold 100 shares, then you're going to make $1,000. Now to make that $1,000, you've had to have invested $20,000. Now on the contrast, if you were to have the call option, which remember controls 100 shares as well, however in this case a single call option contract only costs you $5, therefore $500, because you want to control 100 shares. If the value of IBM shares rose by the same amount, $10, in this case the value of your options contract would only increase by 50 cents per share. So instead of $1,000, it would actually increase by $500, half the amount. However, in this case you've made a 100% return on investment, whereas in the other example you've had to have spent $20,000 to make $1,000. Here you've made $500 profit with only spending $500. So there's lots of benefits with trading call options. You still profit as the stock rises, your entry cost is a lot lower, and your return on investment is much greater. However, you do have to be right, not only in the direction that your stock is going, in our case we want the IBM shares to rise, but you also need to be right in how long it's going to take for your stock to rise to a particular level, because the options contract has an expiry date, and you must therefore be able to predict where that stock's going in terms of its price direction and how long you feel it's going to take to get to its targets.